options, and that's why you are here. So I'm excited to go over that. You saw the brief outline in terms of what we'll be going through in regards to the basics on options. And then I want to quickly get through that, and then at the end, be able to open it up to questions. So that way, everybody will have an opportunity to ask directed questions regarding options. And then we'll go from there. So let's see. Here are the participants. Let me just do that. Alrighty, very good. Voila. Okay, so this is the basic outline of what we're going to do regarding options. Alrighty, so it'll be real quick, and then at the end we'll open it up for Q&A. Just wanted to briefly introduce myself. Other than, let's see, so other than Susan, Americo, and Caesar, everybody else does not know who I am. So let me just introduce myself. That's my mugshot. That's my LinkedIn. So you'll be able to kind of check in and find out a little bit about me. Part of introducing myself and showing you my LinkedIn information is so that you know that it's not some 25-year-old kid in his grandmother's basement doing this stuff, okay? So just to give you an idea, I do have over 10 years of background in the financial industry. And as a matter of fact, I was a fee-based financial planner for Prudential for almost 4 years before I went off and started my own company. And one of the things that I got to appreciate about moving on and doing my own company is that I'm still a fee-based planner. I do have clients still working with me who have become longtime friends as well. And I'm able to talk about two things that I could not while I was a financial planner. Number one, to talk about real estate. And number two, most importantly, which is the subject matter for today, is talk about options. What are options? Okay, so let me first start off by, let me move this over to the side so I have an outline to work with. Okay, so a lot of people are unfamiliar with options, intimidated by options, which you should not be. And a lot of people have heard enough of half-truths regarding options. One of the big ones is options are too risky. Those of you who have watched the whole GameStop AMC battle taking place between the Wall Streeters and Wall Street bets, that has to do with a particular type of trading called short selling. And it actually tied into buying and selling options. And that's how the price of GameStop went up to over $300, is because not only did you have short selling, but you also had options into play. And so that type of volatility would not be possible or would not have happened if options were not involved. And so voila, that's what took place, right? And so I wanted to kind of address some of those issues first with everyone, so that way you have a basic understanding of, number one, what options are in relation to stocks. And then number two, how do you trade them in a way that would benefit you? All right, so let's first start with the difference between stocks and options. Stocks are basically shares of equity in a company. So when you buy one share of Apple, you're actually an owner of Apple. and those stocks are yours to keep for as long as the company is around. Options, on the other hand, they're not equities, but they're actually an insurance contract, okay? Or let's just call it simple contract. Forget the insurance part for now. And what you're doing with an option is basically saying, hey, look, I want to have an options contract. And what that is basically is an agreement for you to buy a particular stock, let's say Apple, by a given time at a given price. And you're willing to pay a certain amount of premium to that. So let's say for simplicity's sake, Apple is priced at $100 a share. And what you want to do is you want to be able to buy an options contract that says, hey, in about 3 months, I want to have the right to buy Apple shares at $110, and I am willing to pay $150 for that option. Okay, or as a matter of fact, if you were to be a little more realistic, it would be the difference between buying 100 shares of Apple at $100. You would have to spend or invest $10,000. With an options contract, instead of expensing out $10,000, you would be spending about 15% or $1,500 for that one options contract. Okay, so that's what the fundamental difference is: the cash outlay. In one, you're obligated to invest $10,000 in order to own the stock. In the other, you are reducing your cash outlay down to $1,500, but you're committing yourself to buy it within 3 months at a set price. That price is called a strike price. So that would be at, say, $110. And the premium is your cash outlay. And that cash outlay would be approximately $1,500. Okay, so for 10 to 15%, you're able to leverage yourself as if you were buying 100 shares. Okay, so for example, one of the, before I get into the options being too risky, another thing to note about options is that it is completely marketable. In other words, if I buy a options contract for March, okay, with a time frame of March, that's when it expires, right? What that means is that between now and the end of March, I have the right to buy 100 Apple shares at a price of 110. Okay, so I bought that, let's say, in the beginning of January. The very next day, I can sell those options. Now, I can sell it at a loss because Apple went down, or let's say Apple had an upgrade and all of a sudden Apple is already $110. But here's the thing. You have an options contract that commits you to buy it at 110. Okay. So because it has already reached that $110 price, all of a sudden your options are worth more. There is somebody out there, an investor, who's willing to pay more for your options contract. And they're offering, let's say, $1,900. Now you bought it at $1,500. So you can keep it and say, you know what, nah, I'm going to keep it till end of March and then buy myself Apple. Or you can turn around and say, hey, you know what? I'm going to sell it at $1,900 and get myself a $400 profit, a very quick $400 profit within, let's say, 2 to 3 days. So you walk away with having spent very little money and making $400 just because the price of Apple went up like that. Okay, so you can sell those options in the marketplace as if it were shares of a stock, okay, of Apple. Just very marketable. You can go in and out, and the price is determined by the market as well as the strike price and how much time there is in the option. Okay, so very quickly, the difference is the cash outlay. And one contract allows you to leverage 100 shares of any given stock. So let me give you an example. Here's QuantumScape. I'm assuming, let's see. So I'm assuming that everybody can see the screen and you can see the chart for QuantumScape. Here's a stock that is, yeah, it's around the same price of Apple. Okay, so let's say on December 22nd, you heard about QuantumScape. It's a battery, it's a special type of battery technology that's supposed to be earth-shattering, and Bill Gates is involved in it. And there's glowing reviews and articles about QuantumScape being this fantastic company. And the price on December 22nd had gone up as much as $130. And then when it drops to about $100, you go, hey, you know what? I'm going to buy this. So you buy this at $100, okay? And you bought 100 shares. So you have spent $10,000 to buy 100 shares of QuantumScape, okay? Or if you don't have $10,000, you can go, hey, you know what? I believe in QuantumScape. Let me buy one contract at $100 ending 3 months from now. And this one, the cost will be to you $1,500. Okay. Now, let's address the question of options. They are very risky. You can lose 100% of your money. Is that true? Yes, it is actually more truer in an option compared to a stock, because unless you hold Hertz stock or Blockbuster stock, remember Blockbuster? Those things have gone down pretty much to zero, or with Hertz, almost zero. Can stocks go down to zero? Yes, it can. But they're not as likely in comparison to options. Okay, so then the question is, well, is it more risky then because you can lose 100% of that? Well, let's think about that. So let's say you bought QuantumScape at $100, okay, and we fast forward this to, let's say, over here. Now we're in January 5th, and the price had dropped down to $59.60. Okay. Now, for those of you who are holding shares, okay, your shares have gone down 40%. But the net loss in dollar amount is actually $4,000. At this point, most of us will feel very, very sick to the stomach and wonder, what are we going to do? So this is what happened. There was actually what you call a dead cat bounce. It was dropping. Boom, it bounced up. And then once it reached around upper 60s, upper 70s, a lot of people came and they started selling that. And then when it dropped down to 65, a lot of the people who bought here were like, uh-oh, it's going down again. I don't want it to go down any further. I'm selling at 65. So some people sold it here. Some people sold it at 60. Some people sold it at 55. And it just kept on going down. Okay. So let's say you sold it at $50. You have lost only 50%. Now you still have a stock. You still can hold it. And maybe in about a year or two, or 6 years or 6 months, who knows, it'll go back up to your original price of 100 and you break even. Okay. So One advantage that stocks have is that you have the advantage of time. You can hold it for as long as you need to in order to get back your money. Now with options, you don't have that because you're actually buying a set amount of time. So if you bought it 3 months out and you spend $1,500, okay, by the time it goes down to here, and then let's say, oh, there's a nice little pump over here. Let's say it has reached February 16th, okay, 2/16. Your options have just expired, let's say, okay, because that was Friday. So last Friday, your options just expired because you were obligated to buy it for $110, but the price of the stock is down in the 50s, okay? So you have lost 100% of your premiums. But in terms of the dollar amount, you have actually limited yourself to a total loss of $1,500. Okay, so in that situation, which by the way happens a lot more often than you think, especially in a very crazy market that we're in right now, which one would you rather have? Would you rather have 100 shares of stock, having spent $10,000 or invested $10,000? Or would you rather have been in an option where you have limited your losses at $1,500? Well, if you were given more choices than two, you would rather not be in it at all. But if you had to choose between these two, I believe that 99% of us would choose the options, okay? 1% will still choose a stock because they're still thinking that, well, I got time. I can get it back eventually, okay? Whereas the options is completely gone. This one, I can always get it back. But please understand this too. Percentages also work the other way. If you lost 50% in a stock, what percent do you have to gain in order for you to break even? And the answer to that is not 50%. You actually have to gain 100%. Your stock actually has to double in order for you to even break even. Okay, a long time ago, I used to own Juniper Networks, which doesn't exist anymore. And I just let it watch it go all the way down because I was taught, hold, just hold it, and dollar cost average down, every time it drops 5%, just buy more, just buy more, just buy more. And guess what? That's what I did and wound up losing pretty much all my savings at that point. And it didn't work out. And in order for it to come back, it had to actually increase by like 800% in order for me to just get my money back. So I gave up hope. I sold it. So just keep in mind that the 1%ers who hold to that stock, you can do it. And it does come back eventually. But you also have the issue of time. So the 99% of the people who prefer using options, this is where you can benefit. Now, this is what happens when it goes to the crapper, okay? And it does happen. What are the options best for? Options are best for when you are in a situation where the price can increase. So let's say, for example, here's a real life scenario. Around here, November 9th. There was a company called Jumia Technologies. Jumia basically is the Amazon of Africa. And when I've heard about that, it was around here. And I didn't jump in because my indicator was telling me to sell. I was like, oh, okay. So I'm not going to get in. And I waited and I waited. Sure enough, it actually tanked. So I was very happy and glad that I didn't get in and saved myself a whole lot of headache. And so finally, when I saw this, there was a buy signal and there were a bunch of confirmations telling me that this is the right place for me to get in. I had the choice of either buying it in stock or buying it with options. Okay, so let's say I'm going to choose two people here. I'm going to choose, so Susan, okay, you're going to buy 200 shares of Jumia because you're not familiar with options and you are kind of afraid of options. Is that fair? Okay, I'll trust that it's fair. So Susan gets to buy 200 shares, all right? And then Justin Giraldo, are you there? Hello, Justin. Kimberly, I know you're there. Hello, Kimberly. Oh, I can't unmute. Okay, there we go. Kimberly, so you're there. Great. So are you familiar with options? No, you're not. Okay. Why can let's see. There is a function here, I believe, where you can unmute. Okay, here you go. Voila.
Better.
There you go. All right, now we can do some interaction. I was wondering if everybody just fell asleep. Was I that boring? Huh?
No. We were trying to unmute, but we couldn't.
Okay.
So, okay,
yeah, we've been trying to unmute for, at least I tried, and I got a message saying that you had us.
Oh, I see. See,
yes.
Okay. I'm not 100% at this. All right. So let's say, so Susan, you're going to buy 200 shares because you're not very comfortable with options.
Okay.
And then Justin, since I chose you first, are you familiar with options? Somewhat? A little bit?
Did you say Justin or John?
Justin.
Justin.
Are you familiar with options a little bit?
I'm not sure if Justin is available. This is John.
Oh, John. Okay. Yes. It says Justin Giraldo. So.
Oh, okay. I'm sorry. I must have. My son uses my computer, so he must have logged. Yeah. Okay. My son's name is Justin, but yeah. Okay.
There you go.
I'm actually John.
Okay.
I'm not. I have been studying this side of the stock trading.
Okay.
It seems a little bit complicated, but now that you're putting it in a graph and you're kind of explaining it, and I'm also kind of talking to Caesar on the sidelines.
Oh, you know Caesar. Great. Wonderful.
Yes.
Wonderful.
So yeah, he's been teaching us a little bit about this as well. So it's starting to make more sense.
Great. So guess what, John, I'm going to have you actually buy two contracts, two option contracts in Jumia. And we're going to compare our trajectory with Susan. All right. So okay. Susan, you bought 200 shares.
Okay. How much each? How much a share?
So we're going to buy it at $1,400. So you're spending $2,800 for 200 shares.
Okay.
And then Justin, since it's around 14 and we're buying it out like 3 months in advance, you only have to put out about $400.
Okay.
Okay. So $2,800.
Is that 400? Is that 400 the cost of two contracts?
Two contracts, yeah.
So is each contract like $200?
Each contract, yes. And then each contract represents 100 shares.
Okay.
And that's based on the stock price at the moment.
Correct.
Okay.
Amongst other things like volatility, time, strike price, there are whole variables. But for now, just to keep it simple, John, you invested $400. Susan, you had to kind of scrape and scrounge and break the piggy bank and bring in $2,800 to buy the Amazon of Africa. All right.
Okay. Got it.
So here we go. We get into the market and we bought that. All right. And then every single day, so each candle represents 4 hours, right? So every single day, we're watching 2 candles at a time. You finish work, you come home, and you're watching this and you go, huh, okay, Wow, wow, hey, look at this. Wonderful. Okay, and it keeps on going up, and then you're happy with it. Oh, there's another buy signal. That's awesome. Okay, and then this comes. So my indicator says sell. So I telegram you or I text you and I tell Susan and John, hey guys, then I don't know if you see this, but indicator says to sell. This is the right time to sell. You're going to sell. Okay.
Okay.
And so you do. And Susan, you get to sell it at $3,400 at $34 right here. And
Okay.
because you bought it at 14 and you have 200 shares, you have made a total of
$20 times 200,
$4,000.
Yep. Okay.
$4,000.
Cha-ching.
Not bad after, just less than a month being in the Amazon of Africa, right? So you basically, more than doubled your money right there. Now, well, almost double. Okay. Now,
Yep.
at the same point, John here had 2 contracts. Now, you only invested $400. Okay.
Right.
And you kept it all the way until it came here. And then you also sold it at 34. So when it was around 34, this is November 30th. Your option contract doesn't expire until January, right?
Okay.
So you could still keep it. But again, option contracts in stocks are marketable. They're not like mortgages. They're not like a life insurance policy. These are marketable instruments, and so you go into the marketplace, and you're able to sell it. Okay, so now you put in $400 for 2, and you sold it at 34. How much do you think, with that $20 difference, how much do you think you have made? If you had to guess, without Caesar's help.
Without Caesar's help, let's see. Would that be the $468 since I only had 2 stocks? No?
Okay, 468. Okay, the right answer is about $4,000.
Hey, can you explain why?
Yes, because each of the contracts represents 100 shares. So what you're doing with those 2 contracts is you're leveraging the power of 200 shares that Susan has and having the same result.
Oh, nice. Okay. So
But
pretty
he
much,
loses his 400, right? He loses
you
the
get it back.
400. Oh, you do get it back. Okay.
See the difference?
so in this case, I'm pretty much doing, what is that called?
You're leveraging. That's what we call it. You're leveraging your $400 to act like a $2,800 investment, basically,
But without having to put out $2,800.
without having to risk $2,800. So that is the power of options. So while Susan, you have made 150%, John has made over 1,000%.
Right, because he didn't have to dish out $2,800 initially. He had to only dish out 400.
Yes, that's the strength and the beauty of options contract. You're able to leverage your buying power. Okay, and where this plays out the best is when you go to like an Amazon where the price is $3,000. So John, I need you to buy 100 shares of Amazon.
Okay.
So I need you to get me $32,000. I'm sorry, $320,000.
Okay.
We don't have that type of money. Most people in retail do not have that. Okay. So that's where options come into play, where you're able to enter into something like this and be able to leverage it to a much greater extent. Okay?
So how much do you, how do you know how much each contract is? Like, I mean, does the price of the contract change based on the stock?
So at any given time, when you go into a platform, you're able to look it up based upon expiration date, based upon the strike price, and then it'll give you the price of that contract at that moment. Okay, so typically the best rule of thumb is 15%. Okay, that's the best way to think about that. Alrighty,
15% of whatever the current value of the stock is, like at 100. Okay,
about 15%. Okay, now,
and are all contracts, are they always sold in blocks of 100?
yes, every one contract is worth 100 shares of any stock. So whether it be Tesla or Amazon, you buy one contract is 100 shares. Okay, so let's then go into how to choose stocks. We'll go into that. Let me kind of now jump into a simple options contract. How do you get into an options contract? Okay, so let's choose, actually, I already have Baidu. So Baidu has been a really good company and very profitable for me, right? I already have that. Okay, I need something that's not showing up. Okay, so here's another company. It's a holding company. Doing really, really well, high quality. Investors Business Daily has rated it up as one of the top 50 companies to get into. All right, and we're looking at that. It's $148, and gosh, if you have, let's say, $50,000, and you have to spend $14,851 just to buy 100 shares, that's just a lot of money. And a lot of percentage of that money going into one company. That is just way too risky. And so this is where you want to be able to go into an options and be able to choose. So this is Thinkorswim. I'm using the paper money option. The market is closed, so the numbers are going to be static. So let's just pretend that they are real. All right. So today is February 15th. All right. And we want to buy, let's say, May 21st. So there's something that's 3 months out. Okay. In 95 days, this will expire. Unless you exercise it, it will expire worthless. All right. Today's price is 148. Okay. And let's say that you want to be able to buy it for 170. You think that the price is going to go up, so you want to be able to buy it at 170. So you click that, all right, and what Thinkorswim will do is that it'll fill it up like this. Okay, it'll allow you to buy one contract dated May 21st, so it's 95 days away, with a strike price of 170. Okay.
So the strike price is what we hope or want the price to be by May 21st.
The strike price is what you are, in essence, agreeing to pay in order to buy this particular stock. Okay. The price has to go higher because you're paying a premium of $34.20 to buy this contract. Now, $34.20, oh, that seems cheap. Well, hold on. You remember, it represents 100 shares.
Shares, yeah. So multiply that by 100.
Mm-hmm. So it'll cost you $3,400 to be able to buy this particular contract. So once you do that, all you do is just send, and it goes right in. And on the first market open, when that price, as long as that price is accepted by somebody, you will own a May 21st contract with a strike price of 170. So whenever you see 170, there'll always be like a C or a P. C means that you're going to buy it. P is for put, and it means that you want to sell it. So for now, just consider this as a simple way for you to enter a contract. Now, wow, that's $3,000. I don't have that. Well, it beats spending $15,000. All right. It's manageable when you have like a lower price stock like this. TRIT, can't even say it correctly. TRIT, right now it's at 780. And in May, let's just say somebody told you that you can buy it at $10. Okay. At $2 a contract, that means it'll cost you only $200 for you to buy one option in this stock. Okay.
So in the event that the contract doesn't sell, do you have to buy it?
When you say it does not sell, how do you mean?
Because you're saying you're making this contract and you're putting it out for sale, or you're posting it out saying it's going to go up to a certain amount. And if by that time, when the contract is expiring, if it doesn't meet that amount, do you have to buy it, or can it just be canceled?
No, you sell it or cancel it, and then you only lose your contract price, right? Whatever you paid for the contract.
Okay.
So
right? I don't know, I guess.
Yes and no. Again, because this is marketable, right? Every single day that the market is open, this May 21st contract price will fluctuate up and down based upon the stock price. So if ever, now you've put in $200, but let's say somebody a month later comes back and on this a bid and ask platform, it's saying that somebody wants to pay $4. Okay, like over here, $4.50. Somebody is willing to pay $4 for a May 21st contract. Okay, you have the option to come back in here and say, you know what, I am going to sell. All right, so let me use another example. Okay, here we go. So here's IO. It's an August 20th contract that I bought, right? And I bought it at basically $1.65 each. I have 10 contracts, okay? And suppose that in March, IO has gone up in price to such a point that somebody is willing to buy it at $5, okay? So what I can do is I say, you know what? I'm gonna sell half of my holdings at $5, and not only am I going to get back all my investment, I'm going to make a little bit of profit as well. Boom. And let's pretend that it's sold. Not only that, you still have 5 contracts available for the future in order for it, for the price to either go up or for you to eventually buy the stock. Now, having said that, if anybody else, by the way, who's here, if you have questions, just type it on the chat. And I'll be able to, I'll try to address it because I'm watching that as well. Just keep this in mind that even though you're making that commitment in a contract, okay, 99% of option contracts are sold before the option expires. Why? Because the majority of people are using options as a way to trade like you're trading stocks. So then the question from Kimberly is, how do you know somebody wants to buy? you'll see it here in the option chain, okay, based on the bid and the ask. So the ask price are the sellers, the bid price, I'm sorry, so it's higher, right? So the bid price are the buyers and the ask price are the sellers, okay? So eventually, if you see this thing go up and it's like $5 instead of 70 cents, it's like, no, I have the 5 here. So right now it's $1.45. Somebody's willing to pay $1.45. Well, I'm not going to sell that because I bought it at $1.65. But eventually, 1 month later, as this changes every single day, it goes up and down, and you see the bid price going up to $4, $5. Kimberly, it doesn't matter who he or she is. It doesn't matter if it's a retail investor or a Wall Street institution. Whoever has the highest bid price will show up right here. And if it is that high, like $4, okay, because you bought it at $1.65, and somebody offers $4, you can go in there and just sell it. Okay, so just like you buy and sell stock immediately, in and out, okay, you can just, so let's take Boeing, for example. All righty, so Boeing price, this is the stock price, 211, okay? So somebody is willing to pay 211 to buy it. So there's 200 shares that somebody wants to buy at 211. And on the flip side, somebody is willing to sell 300 shares at 211.09. Okay, so if you want to sell it, you click here. If you want to buy it, you come here. And it's very quick. It's very liquid. It's right there. Okay, that's how quick. That's how modernized the platform has become. And just as you can easily sell a stock here, you can 90% just as easily sell an option here. Okay, so that is the main differential. So let me kind of pull back a little bit and say this. Options, for those of us who trade options regularly, okay, like I, for example, I've moved from trading stocks to like 90% options, 10% stock. Okay, is the bid price a number of contracts? 100. It's 100 shares. So the 100 represents, I'm sorry, the bid price here. So 2 represents 200 shares, correct. Okay. So in terms of trading options, I've moved 90% towards trading options because I'm able to leverage my money quicker, and I'm able to get out in and out of options with a bigger profit quicker. I can get 100% a whole lot faster than waiting on a stock to reach 100%. Okay, so options are helpful when you have great upward movement, like we're looking at Jumia. When you have this type of movement, right, in a stock, it has only moved up 150%. Well, if I have options, you know, I've gained 1,000%. That's the power of options. So on the upside, this is what you get. On the downside, you also have the protection, because in this one, instead of losing $5,000, $6,000, I only lose the total of my premium. I cannot lose more than that. Okay, so in QuantumScape, it would have been $1,500. If it is in Jumia, going back to this example, let's say it didn't do this. Let's say, okay, yeah, let's choose here. Right there. So let's say you bought it right there, buy signal, you bought it there. And you bought 2 contracts and at 44, so this cost you about $600. Okay, but it went the wrong way. It went from 40s all the way down to 34, 35. So I've lost $600 here. Okay, but my losses are capped at the amount of premium that I have paid. So the most I can lose is $600. Whereas if you had 200 shares, that's $8,000. By the time it drops over here to 35, I lost $1,000. Okay, so that is the other side of options. Yeah, can you lose 100%? Yes, you can. But from a dollar amount perspective, you're able to manage your losses. That is the beauty of options. Now, what are some of the risks of options? Obviously, it's the fact that the pricing moves very quickly. So just as quickly as it goes up to 100%, 200%, it can go down 40%, 50% real quick. Okay. And for beginners, here's one thing to keep in mind. For beginners, your emotions can easily get in the way of looking at that and go, oh my gosh, 40%, 50%, I've lost it, and panic. But in options, you got to make sure that you do not panic. Okay. That's why in our team, we practice buying options the further out. So if it's like 2, 3, 4 months out, you don't sell in panic. Okay. If you have because you can sell an option that is just 2 weeks out with a 2-week expiration. And those things, like from here to here, it'll go down to zero real quick. So we avoid that as much as possible. Okay. So Amir, in the case of options in Jamia, you make 1,000% only if you decide to exercise your contract and sell at the market price to make use of the profit. You actually gain the 1,000% both ways if you have the cash. So going back to Jamia where we were, right? If you bought the, like down here, if you bought it for $400 and then it gets up here, let's say you decided to buy it. You bought 2 option contracts at around here. So you decided that 3 months from now, you're going to buy it at the price of, let's say, $16. Okay. When the price goes up all the way to $38, $40, $35, $36 over here, okay, when you exercise your contract, you can buy 200 shares of Jamia at $1,600. You just need to pay up $3,200. Well, minus the 400. So in total, you fork over $3,600 and you will have 200 shares of Jamia. Okay, so you can exercise those contracts that way. Okay, or just sell the contract itself and keep the profits. Because if, let's say, you bought the 200 shares, let's say over here, and then the next day you sold the 200 shares, the net effect would be very similar. Minus commissions, it'll be pretty much the same. Okay, so that is the basics of options. Okay, now the question is, how do you choose the stocks, and what is so important about options? The most important part about options really is time. Because you're buying it for a time. You're buying it for 3 months. You're buying it 4 months, 6 months, a year. That's it. So within that time, the price of the stock has to move at a certain level in order for you to earn a profit. And so it is very important to find yourself in situations where you find yourself around here at the low end where there's a trend change. So here, for example, we're able to see the color change of the candles. The yellow line, when it crosses over here, and this indicator is called a modified golden cross. So that's a very positive indicator that the trend is starting to change. When you have volume that is above average, it's telling you that institutions are buying into it. So that gives you greater confirmation. So here's above average, higher, higher, higher. So you know that from here all the way out, and these are also higher too. So from here all the way to here, you know that institutions are buying. Okay. And this is where you want to be. You don't want to be buying here and then find yourself in a downturn, or another worst case scenario is that the price basically trades in a flat pattern like this, where it trades between 31 to 45 and it just doesn't go up any higher than that. Okay, because at that point you will be either making very little money or losing a little bit or just breaking even. Okay, so finding the right spots are important, and that's why we use certain indicators. What I use is basically the volume indicator, right? Yeah, and green means in general positive volume, and the above average volume is based upon the just the graphic. So when you look at here, 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 it's pretty much this is the total number of shares that have been traded. And when you compare it to the average, which is right here, this is your average over the past 10 to 12 trading periods. And then the rest of it is above average. So whenever you see above average and it's on an uptrend, that's a very, very positive sign. Okay. And so I've put in indicators such that not only does it give me a buy signal, but I'm able to read other indicators like the blue line and the yellow line. I'm able to read Japanese candles. I'm able to read these two. I wrote this, I just called it crossover by CJ. Yeah, I'm very vain, sorry. When this red line here turns green and it goes above the blue line right there, that's a positive confirmation that this is a good entrance. And so over the past 3 months, we have found multiple stocks like Jumia, Palantir, Baidu, where we profited by over 1,000%. So here's Baidu. One of our team members actually called it out. We got in here and rode all the way up to the first sell sign where we sold one contract. And then the second sell sign right here, we sold the second contract. And in combination, they averaged out to about a 1,300% profit. So this paid out easily about $3,800. Okay, so it's very important that you get into at the right location where the stock price is just about ready to shoot up. Okay, you don't want a flat lining stock. So for example, this is, let me go on a daily, which is a little bit better. So this is AT&T. And by and large, if you look at the red line here, it is from March of last year up until now, it has been basically flat. And so this has been really, really tough to make money out of AT&T. I think in our team, those of us who jumped into it, including me, we basically lost money into this, and we just either are still holding or got out because it was hardly moving. You know, there was hardly any life in AT&T. So is this graph on Thinkorswim? No, it is only available on Tradingview. Sorry. But the beauty of Tradingview is that every active trader is aware of Tradingview. They use it. The indicators are far better in here. And this is the only place where I'm able to put my own Pine script and install it into the program such that I'm able to use it and let it do what I wanted it to do. Can you do it on Thinkorswim? Yes, but I haven't gotten around to relearning their language, which is slightly different than Tradingview. Yeah, so that is the gist of it. Let me go over some important elements to it. Okay, let me bring back this. All right, so here are some of the important elements in regards to option trading to make sure that you are successful and you don't blow up your account. Proper risk management is key, okay? And what I teach is whenever you get into a stock or an option, try to scale in at 2%, okay? And scale up all the way up to no more than 5% of your total portfolio, okay? So if you have $10,000 in your account, do not invest more than $500 in stocks or options in any given account or any given company, mainly because you don't want to be overweight in one of them. Because while you'll be making a lot of money if it succeeds, guess what? It'll cripple your account if it goes down the drain. Okay? All right. Amir, you're asking, I'm selling a contract that is due to expire in 2 weeks. Would there be buyers interested in buying a contract that would expire pretty soon? Yes. As a matter of fact, if it's close to the money, you can sell it on the day of expiration. Now, you're not going to get a whole lot from that. But even on the day of expiration, you can sell your contract. Definitely. But typically, the best time to sell it is within 4 weeks to up to 2 weeks of expiration, because that gives you enough of premium value over and above the price of the company that you can sell it in the open marketplace. Yeah, definitely. So going back to key elements, proper risk management, 2 to 5%. Okay, so even if you put 5% on any given company, you still have 19 more bullets, so to speak, to be able to get into other contracts and be able to succeed. And with options, if you are, especially if you get out very quickly the moment you see a sell sign, and then when you see a buy, and then you just ride it all the way to the top and you shoot the moon, so to speak. Anytime you get 500% or more, we call it shoot the moon. And boy, is it fun when you do that. You really just need to be correct about 40% of the time, and you'll be in profit at the end of the month, at the end of a quarter. Obviously, you want to get better and better. And if you can hit 60 to 70%, that is awesome. So I sucked in the beginning, and I've gotten to a point where I'm pretty okay, you know. Proper entrance, more than anything else. Proper entrance, okay? Choose the indicators that work for you. Different traders have different philosophies. Some people like to use stochastic. Another one is called the RSI, or Relative Strength Index. Others like to use a weighted volume average. Others like to use what they call a CCI, or channel index. There are all these different names that indicate something about the stock price that gives you a sense of, okay, this is a good time to get in. This is a good time to get out. You need to choose which one works best for you. I have chosen what has worked best for me. And one of the reasons that I know that it works best for me is that in 3 months, I have increased my portfolio 700%. So yeah, it's working. So the key question to ask whenever you get into a contract, this is key. Majority of people go into a contract, an options contract, and go, oh, look, I can make 150%. Oh, look, I can make $1,000 if this really hits. That's the wrong question to ask, really. Yes, you should ask about profit, of course. But the more important question is, how much can I lose? Even more important than that is, how much am I willing to lose? Okay, so that has dramatically changed my way of trading. How so? When I go into a contract and I put in $400 for this one, or $800 for that one, or $1,200 for this one, I go in with the mindset of, I am willing to lose all of this, 100% of this, because I believe in this stock. I know this can get up there. The indicators tell me I have a buy signal. I have 8 confirmations. I have Fibonacci retracement showing me that it's bouncing off support. I have institutional buyers. The volume is showing it. I am 100%. This is going to be a good stock. And I am gung-ho. And I'm that right there from the get-go. I'm putting in 5%. And I'm like, you know, I'm willing to lose $1,200. So when you go in with that mindset, it's amazing how you don't panic as much. Because I have seen my options go down to like minus 70%. And then as it gets close to the expiration, go up like a 200% profit. I kid you not. Many, many a times. Oh, George is here. George can attest to that. Many, many a times. It happens like that. And the reason I'm able to do that is because I already go in with a mindset of, I've lost it all. Okay, so think of it this way. Think of it in binary terms. Okay, those of you who watch Super Bowl and those of you who were rooting for Kansas City to win because they were the favorites, right? And you're so sure they're going to win, right? And you put down, oh, they're going to win. Of course they're going to win. Doesn't matter if it's Tom Brady, you know, Kansas City is going to win. And you put down $400 into the game. Well, guess what? That's a binary bet. The moment you bet, that money is gone. There's no, oh, I changed my mind. Can I get it back? Or, hey, can you give me back 70%? Can I get a partial refund? No, no, no. It's all gone. It's all gone. So that's a binary bet. That's gambling. In options, it's not binary. It is not gambling. Okay, well, people do gamble, but you don't have to. It can be a very educated, calculated investment. And the beauty of that is that, yes, you go in there with 400 and you're willing to lose it all. But the moment the sell signal comes in and you're already minus 20%, you're able to sell. And you're willing to lose that and get back 80%. Okay, so you're not going to lose 100% all the time, obviously. But you're going in with that mindset of how much am I willing to lose? Okay, and lastly, the secret to success is closing at the right time. Okay, how many of you have experienced FOMO, where you got into a stock? Let me go to Palantir, because this is what happened to Palantir. You go into a stock like Palantir, right? And where did it happen? Oh yeah, right here. So you get into a stock like Palantir, right? And it goes up. So you bought it at 11, let's say, and it goes up, and then it goes to this point where it is actually very, very choppy on this day. It went from $16 down to 14, and you're watching the screen all day long, and you saw it go up to $1,600 and $16, and you go, oh my gosh, look at how much money I've made. And then you saw it go down and keep going down and keep going down. And then you have this fear, oh no, oh no, oh no. So you sell it in panic. And you go, oh goodness, thank goodness I was able to make at least 80%, right? And then this happens. It just jumps from there, from that 16 all the way to 30. You just experienced FOMO.
Oh yeah.
You've missed out. Somebody have a question?
No, yeah, no, I was just saying, you were asking who, it's happened to me.
It happened to you?
Yes.
So how much profit did you potentially lose?
Oh my God. I mean, I bought this stock at around 80. I sold it at around 100, and I think it might have been like 120. Now it's like 190.
So we look at that and go, hey, if you, let's say you had 100 shares, it's like, hey, I made $4,000. That's, and rightly so, you did. But the opportunity loss was how much? A lot more than that.
Yes.
Right? So
Yes.
selling at the right time is important. Okay. So over here with the Palantir account, we sold it right there. Why? There's a sell sign. And sure enough, it was trading sideways for a long, long time. You know, same thing with Baidu. Yeah, this was a big jumper right there. Okay. But some people have held on and they didn't, there was a nice bounce over here. It's like, oh, okay, Baidu is going back up. And then they experience this and they're holding on and they're holding on and they're holding on, and it drops all the way down here. Okay. So this is another type of FOMO where you sold too late. Anybody sold a stock too late? Yeah, Novavax and plug. Yeah. Yep. For sure. Did anybody get into GameStop and you held on because they said to hold on? You know, so
Thankfully, no.
I'm sorry?
Thankfully, no.
Thankfully, no. Very good. Yeah. So AMC, same thing. Once it reached a particular level, the moment there was weakness and said sell, got out. So that's getting out at the right time is just as important as getting in at the right time. Okay?
DJ, can you pull up either GameStop or AMC and like just use that as a use case?
So alrighty, so here we go.
I mean, we all heard it in the news, right? So
yeah,
like, where would it have been like the best time, like based on your analysis, right? When would it have been the best time to sell, right? I see a little arrow where it says to sell.
Yep.
But you could have bought when? Like there were two opportunities to buy, right?
Here's a buy, here's a buy.
The buy.
So you could have bought it even at 46, which is still too expensive, right?
Yeah. And
you could have sold it at around 200. And I mean, here's the thing: we can never hit the top. Okay, that just rarely happens. But the moment we saw this, boom, 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 and there's a sell sign, you could have sold it at around here, and still made just in stock price alone, you would have made 600%. Yep. So selling and closing your options or stock at the right time is just as important. Okay, that's going to determine your failure or success. Okay, so if you want to follow more and see some of my alerts, you can actually subscribe and ding the bell to just CJ Chun. Just search it. You'll find it on YouTube, Tradingview, Stocktwits, and Twitter. So if you had to choose two, I would choose YouTube and Twitter, because that's where I post up the stocks that I get into. And not when I get out, but at least definitely when I get into, I post it up there, and I show my charting and my rationale as to why I'm getting in at this price, why I feel is the right place to go in. And even last week, the two biggest successes was IQ. In a matter of 2 days, I was able to clear 254%, and then DocuSign at 62%. Futu, F-U-T-U, I forget the percentage because I couldn't save it by the time I sold it, but in dollar amounts, it came out to $2,600. That paid a good amount of bills for sure. So that was really exciting week this past week. And those all came from getting in at the right time and getting out at the right time. Okay.
Are all stocks optionable?
No,
Okay. How do you know if a stock is optionable or not?
it'll show up on, so when you put in a, let's see, is there a stock called GMT? Oh, look at this. When you don't see the selections for options down here,
Okay.
then you know that it's not optionable.
Got it.
Yep.
And then, so
Mhm,
as
go
a,
ahead.
I have another question. So as a beginner, right? And that's
Mhm.
kind of where I'm at. How do you know what's a good number of contracts to manage? And I'm assuming that's going to vary by person, but I guess, you know, what I'm trying to get at is like, how much time is really needed to like pay attention to this? Because you say like, this is, I mean, this is not passive trading, right? By any means.
Mhm.
You do have to actively be monitoring this. So
Mhm.
I guess for someone like me who has a full-time job, right,
Yeah.
but also wants to maybe explore, you know, getting into options,
Mhm.
I'm just thinking like, okay, based on the time commitment, right?
Mhm.
What is a good number of contracts to manage,
Mhm.
but still be able to pay attention to how the market is moving and, you know, do your research and all that? Does that make sense?
Yeah. Start with 5. No more than 5. No more than 5
What's
companies.
your reasoning behind that?
5 is very manageable. And once you're able to do 5, then you move up in number. But 5 is very manageable because you can stagger your options on every week or every 2 weeks. And so that way you really have to just look at, if you were to look at the charts for 5 companies, it literally takes you less than a minute.
And then how often are you checking on your options, like to look at the status and how it's doing? Is it like 3 times a day? You kind of check when you wake up, check in the middle of the day, check again before things close? Like,
So, yeah.
what does that feel like to you?
So, so here's another principle for you guys to keep in mind with options is this. Never trade options unless you're selling. Never buy into an option or open an options contract within the first 30 minutes of the opening bell, because it goes wild. Okay, and you wind up paying a premium for that. So, so on that note, 5 minutes at around 10:30 in the morning, 5 minutes around 3 p.m. So an hour after, an hour before the market closes, you can check it for 5 minutes and you're done. So that's as simple as can be kept. Okay. So let's see. Let me open it up to everybody else. Could you either type it in or unmute yourself and ask any questions that you have in regards to options? We have I see Francisco, James, C. Smith, Kimberly is here. Okay, Renato, Ed, Manuela Hernandez. Anybody have questions? Yes.
Hi, CJ. This is Amr speaking.
Mm-hmm.
So I've never really traded options, but I kind of know some basic information with regard to the terminologies associated with trading options. So do we really need to go through the nitty-gritty details of knowing what the, let's say, the intrinsic value is, the extrinsic value is, and what the time to maturity and the implied volatility values are for a certain option or a contract, or just as simple as looking at the indicator and knowing that this is a buy signal and this is a sell signal, let's go and do it, boom, and that's it?
Let's just say, so think of an iceberg, right? An iceberg, when you take a look at it, even a small one, 5% of it is above water and 95% of it is under the water, right? So if you want the iceberg at 5% to increase in size by, let's say, just 1%, right? How much of an increase does it have to be underwater in order for the one above it to be 1% bigger? So all that to say is that the more you know, the better. So you can have a basic enough knowledge of options to be able to trade in and out. And as long as you're practicing proper risk management and following some really good entrances, recommendations, and you're able to read the charts, not necessarily know everything about options, but you know enough about stocks and their movement, right? You're able to succeed that way. But during that time, you also want to continually be a student of the craft and get better and better at it, because there's so much to know about options that a brief, 1 hour webinar is not going to cover. So
Got it.
the more, the better. The more,
Thank you so much.
yeah. So
sorry,
go ahead. Go ahead.
I just actually, I have a tax question. So are the gains that you make from options trading, are those taxed as regular wage?
Or yes, ordinary income.
Yeah. Okay. So it's not the capital, or not
Long-term capital gains. Yeah.
yeah.
Correct.
Yeah. Because you're selling and buying you're selling, trading, gaining like within 1 year, right?
Exactly. And so if you're trading options and you're mimicking the rate of return that is similar to like a mutual fund, it's best not to do it. Then this is not for you.
Yeah.
You have to, in a sense, just like you have to beat time in order to make profit in an options contract, you also have to beat the returns to such a point that it overcomes the taxation question.
Right. So let's say I end up making a lot more money than I expected, like trading options. One of the ways that I could probably protect my tax money would be, either take my regular wages that I get from my job and maybe like definitely max out my 401, right? Maybe potentially open up a Roth, right? And divert some of that money over there.
Yeah.
So that my taxable income would kind of still either be the same or not. It wouldn't bump me up to that next tax bracket, right?
And if you are a successful trader, you can actually open up an LLC and trade under that LLC and really manage your taxation. Yeah, that's now we're going to level 300.
Yeah, no, I'm not there yet. I'm not there yet. No.
Okay.
I'm just kind of thinking, tax implications. Like if I do get into this, like this year, how do I plan or shift my funds around so that I'm not hitting this big tax bill at the end of the year,
Yeah.
Right. So like, I don't want to be making all this money and then realize later, oh man, I forgot I have to pay taxes on this. Right. And then, so I got to figure out how to manage that as well. I don't know. Maybe I'll talk to you offline about that.
Yeah, we can definitely talk offline on that and discuss.
No, I just wanted to you know, bring that up though, just something to think about, I think, for everybody, you know.
Definitely. So, and ladies and gents, if we have to have that conversation, that's a good problem to have, because then that means you're succeeding.
Yeah. Right.
Okay, question is the program you're using available to us? If so, what is the cost to get access? Yes, it's available to you. If you email me, let me put in my email, which is again, just my name and Gmail right there. So it's on the chat. So if you email me, I'll send you the video presentation of how this works, as well as you know, all the costs that are involved if you are willing and wanting to get involved in our team. And then I will probably follow up with, yeah, as a matter of fact, if you email me, everyone who's here, if you email me, I will send you a video of another options webinar that I've done. And this one takes you to the next level. So if this is kind of like basics of options, the next one is options 101. Okay, so I think you'll be able to learn that much more from there as well. And another place to really go to is those of you who have TD Ameritrade. By the way, you don't need to have money deposited into it to open an account in TD Ameritrade, but they have an education arm where if you go to that folder and you search for options, there are kind of like, I would say, college level options training. But the beauty of it is that the videos are broken down to like 5 to 7 minutes each, so you can learn at your own pace. So it's a lot of videos. So don't be overwhelmed by seeing all of that stuff. Just take it one piece at a time. If you can just watch 3 videos a week on a weekend, you'll do fine. And within a year, you'll be a master at it as well. Okay, so definitely continue learning on it, because it does allow you to leverage your funds and limit your losses. Because I don't know if some of you are listening to some of what you call the doomsayers, who are saying we're in a bubble, we're in a bubble, and there's going to be a 10-20% correction. Okay, now if we are in a 10-20% correction, okay, our 401ks and IRAs are going to be very vulnerable. And if we are trading stocks, they become very vulnerable as well. Whereas if we are in an options contract, and again, we're limiting ourselves to just 4 or 5 at a time, and we don't open the next one until one of them is closed out, obviously in profit, and the correction comes, all of a sudden, what you have already done is you have created a moat where you have hedged your losses right from the get-go. So instead of losing, those of you who do have a lot of funds, instead of losing that huge chunk that could impact your retirement or impact your daily living, all of a sudden it's protected because you have limited yourself from the onslaught that may come. So will it come? Yes, eventually. When will it come? I don't know. With the $1.9 trillion stimulus bill that's likely going to pass through Congress, the US is just printing a lot of money. And so for that reason, I think it will not happen right away, but because the $1.9 trillion is being spent, that's not good. As a matter of fact, this is one of the troubling things that I am seeing right now. So this is the US dollar versus the Canadian dollar, also known as the loonie. This is the trajectory of the dollar right now. It is continually dropping. That's on a 1 hour. This is on a daily chart. It's at one point it was up at $1.45 for every Canadian dollar. I'm sorry, for every American dollar, a Canadian had to spend $1.45 to exchange it. It has dropped all the way to $1.26. And this over here, it's telling us that we are printing money at an incredibly fast rate, which is not going to be good for the long term. But in terms of the stock market being bullish in the short term, it's definitely going to be bullish, I believe. So here's a bit of a very useful trivia. Since June of last year, for every dollar that's out in circulation, 25%, so 1 out of $4 right now in circulation, has been printed since June of this past year. So in 8 months, we have 25% of our money supply printed by our government, our dear beloved government, has been printed just out of thin air, basically. So, yeah, that's where we're at. Okay, so all the more reason to learn how to do options and master it as quickly as possible. So, is it masterable? Yes, it can be done. And how long do you need to succeed? Less than a year. Okay, just learn it. If you need help with that, by all means, reach out to me. That's my email. Reach out to me, and I can help you in that regard. But again, I'm not the only source out there. There are many other sources available out there. By all means, do take advantage of it. Okay, so if there's anybody else, one last question before we close up, because I have already taken up enough of your time. Thank you so much for joining me. I hope it has been a help to you. If it has been a help, please email me and tell me that I've helped you. So
CJ, could you just real quick look at MYO for me?
MYO, all right. MYO.
See if I've got the 8 confirmations down.
All right. So we're looking at, so Friday afternoon, let's see, we got the buy signal. It's above the yellow line. It's above the blue line. The doji over here gives you a positive confirmation that this is definitely still on an uptrend. You got above average volume. Okay.
And how can you tell that? Because it's green?
No, if I move the mouse and I bring it down to like over here, that kind of puts it like at like the average over the past 10 trading days or so, give or take.
Oh, so you're just eyeballing it.
Yeah.
Okay.
Another way of looking at it is I look at the volume here. So the average in the past 10 trading days was 228, and the volume for Friday was 314. So
it's above
50%.
average.
Yeah, that's 50% more. So that's significant. Another thing to keep in mind is that typically when a stock has gone from single digits to double digits, institutions are allowed to look into it. Before then, most institutions are not allowed to buy into it. Okay, so that's another reason.
because it's considered a penny stock.
Correct. So like over here, you have good volume. Over here, you have good volume. The line here is green. It's above the blue, way above zero. So from a technical perspective, now I don't know much about the company. I think you do. But from a technical perspective, this is what you call a buy with 8 confirmations. And this is the Fibonacci retracement. And yeah, it's bouncing off its support. So that's the support right there.
That's another term that's Greek to me. Fibonacci retracement.
Yeah, that's another whole lesson in itself. But yeah, feel free to reach out to me, and you know, we'll talk more about Fibonacci. I love Fibonacci.
Fibonacci is a pattern. It's a number pattern.
Yep, and
Yeah.
it's that is in existence in stock markets, in organisms, in our faces, in our ears, in our DNA, in a lot of different things. And
Yeah.
it's universally, it just works. Okay, good. So with that, hey, everybody, have a good night. And I have recorded this. So if you want a recording of this, email me and I'll send you the recording.
Thanks, CJ.
Thank you.
Thank you very much.
Welcome, welcome.
Thanks,
Good
CJ.
learning for me today.
Welcome.
Thank you, CJ.
You're
Thank you,
welcome.
CJ.
Thank you, CJ.
What about it?
Have a good night.